Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Okay, so looking back at the recent bearish action, we can see it all started from the failed follow-through higher to both the weekly key reversal up in mid-April and the daily key reversal up on the 19th of April, which also turned out to be an indecisive doji cross right at the top of the recent market. Things then became interesting as we could look at the whole action from the heights of March all the way down until 2 weeks ago as a large bearish halfway hesitation with potential targets below and with target X in the 2030 area being the most southerly. It was one of the most gratifying moments in recent times to see prices drop down to reach target X and immediately shoot back up again. The subsequent juddering rise pushed up through, now these are in no particular order, the congestion at 21.32 to 35, the extension of the lower trend line for the May to June 21 descending triangle currently at 21.46, the middle time currently 20.28 of the March to April bearish shift pitchfork, and also pushing up through but not closing over the 50% Fibonacci on the June to October 2018 move at 22.21. So where does that leave us now? Well, prices have risen just short of the descending upper time, currently at 22.44. And this will be a next major test of the bearish incentive since April. You see, if this is broken, then despite the October 2019 high at 22.63, that's next overhead, I would suggest that we will next see the short medium moving average, currently 22.73, the long 22.87, and the medium moving averages currently at 22.96, all being tested. My only concern with this break higher is that, well, we don't have that much ammunition gathered below, and the overhead congestions are quite daunting. It would, on the surface at least, and looking at it right now, seem reasonable to see the upper time holding off further rises. But as this upper time has not been tested, I cannot vouch for it or its strength, not yet at least. I'll now reprise two separate and somewhat lagging indicators. They are 1, the dead cross of the short medium moving average dropping down through the slowly declining medium moving average, and also the short medium moving average dropping down through the long moving average. That's the second one. Whilst we are waiting for the market to decide which way to go, down or up, I'd like to further nurture an idea I planted in your mind 2 weeks ago, and I've repeated it last week. It is to regard the whole action of 2022 so far, even perhaps going back to November last year, as a possible diamond pattern. This idea is still way too early, but you may hear more on this should it develop in the future. LME 3-month tin. The move down below the flatlining long moving average, currently 39.070, on Monday 4 weeks ago with a bearish opening long black Mariboso, was the market finally making up its mind on what to do with the inverted cup with handle pattern formed between March and early May. The final move down by the middle of May exceeded any targets on the downside as prices had moved down through a fairly free zone from under the long moving average down to the two congestion zones below. First and smaller zone is between 33.665 and 33.475 and contains the old April 2011 previous all-time high at 33.605. The second, larger congestion zone is between 31.845 to 32.985 and contains the 50% Fibonacci line of the March 2020 to March 22 move at 31.845. Now the first zone slowed the drop whilst the second zone finally halted the fall, and both have been acting as supports, active supports, ever since. What had been especially interesting about the first zone was how it managed to hold on up the market on only a closing basis, whilst being the smaller of the two zones. Anyway, the drop fulfilled the downside target, unlabeled as it was so close, of the mid-April to May bearish halfway hesitation and the inverted cup with handle pattern for the March to start of May action. Thus, the market's drop had already fulfilled any potential targets on the downside. As I said 3 weeks ago and repeated ever since, all the patterns for the downside are for the moment fulfilled. So where does that leave us now? Well, it very much depended on the state of the two congestion zones below. The smaller 33,665 to 33,475 zone, and the larger between 31,845 to 32,985. 2 weeks ago I said, and I quote, "If these hold up, then a gradual move over to test the March to date downtrend, currently at 36,535, sometime in June might be possible. However, I would like to again emphasize the one admittedly lagging indicator that should be borne in mind when considering this. It is the dead cross of the short medium moving average, currently 39,390, down through the falling medium moving average, currently 41,300. Whilst this may not be the cause of the fresh fall in the market, due, as I've indicated, to the likely quality of support that is underneath current levels, it nevertheless seems likely to stymie any potential pullback." And that's the end of a long quote. Hence, the inference from all this is, as we have already seen these past 3 weeks, is that we will go sideways. It is only this week that we have seen the market utilize the ammunition gathered over the last 3 weeks or so to make an unusual key reversal up yesterday and try and embrace the downtrend. Even now, today, the market seems wary of trying up to test the downtrend. Now, should prices punch up through the downtrend, the next resistance would be the 50% Fibonacci line of the March 21 to March 22 move at 36,945. Beyond that, on the upside, well, we should start looking at the long moving average as the next resistance. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.